The stock market is holding its breath right now. And if you've got money invested in American stocks, bonds, or even just a retirement account, this moment demands your full attention. On January 30th, 2026, President Donald Trump officially nominated Kevin Warsh to become the next chair of the Federal Reserve, set to replace Jerome Powell when Powell's term as chair ends in May. This isn't just another Washington appointment. It's a pivotal shift that could reshape how the world's most powerful central bank operates, influencing everything from your mortgage rate to the value of your 401k and the strength of the US dollar on the global stage. Kevin Warsh isn't some obscure economist plucked from academia. He's a seasoned player with deep roots in both Wall Street and Washington. Born in 1970, Warsh earned his undergraduate degree from Stanford University and his law degree from Harvard. He started his career at Morgan Stanley in mergers and acquisitions, climbing quickly in the high-stakes world of finance. By his early 30s, he was advising President George W. Bush as a special assistant for economic policy and executive secretary at the National Economic Council. In 2006, at just 35 years old, Bush nominated him to the Federal Reserve Board of Governors, making him the youngest governor in the institution's history. Warsh arrived at the Fed just as the housing bubble was peaking and the seeds of the 2008 financial crisis were sprouting. When the crisis hit full force, Lehman Brothers collapsing, credit markets freezing, banks on the brink, he was right in the room with Ben Bernanke and other top officials. The Fed responded with unprecedented measures, slashing interest rates to near zero, launching massive quantitative easing programs to buy trillions in bonds and mortgage-backed securities, and orchestrating bailouts to prevent a total meltdown. Warsh supported many of these emergency actions in the heat of the moment, but he quickly became one of the more skeptical voices about the long-term consequences. He worried that flooding the system with cheap money would distort markets, inflate asset bubbles in stocks and real estate, erode the purchasing power of the dollar, and undermine the Fed's credibility. During debates over additional rounds of QE, like the $600 billion program in 2010, aimed at supporting housing and growth, Warsh dissented or expressed strong reservations. He argued the benefits were overstated, while the risks of future inflation, moral hazard, and dependency on central bank intervention were massive. When he couldn't influence the direction enough, he chose to step away in 2011, resigning rather than continuing in a role where he felt policy was veering off course. That decision spoke volumes. Here was a man willing to walk away from power rather than compromise his principles. After leaving the Fed, Warsh didn't fade into obscurity. He joined Stanford's Hoover Institution as a visiting fellow, taught at the university, and became a frequent commentator through op-eds in the Wall Street Journal, appearances on financial news networks, and speeches at economic conferences. Over the years, he sharpened his critique of the modern Fed. He accused it of mission creep, expanding far beyond its core dual mandate of price stability and maximum employment into areas like climate policy, inequality, and even social issues. He called for a return to more rules-based monetary policy, drawing inspiration from economists like Milton Friedman and John Taylor. He repeatedly warned that prolonged low rates and bloated balance sheets favored asset owners, Wall Street, big corporations, the wealthy, while hurting everyday Americans through higher living costs and distorted incentives. In 2022 and beyond, as inflation surged post-pandemic, Warsh was particularly blunt. He said the Fed had waited too long to raise rates, losing public trust and allowing price pressures to embed themselves. He criticized quantitative easing as a blunt tool that created bubbles and inequality. His philosophy boiled down to this: prioritize a stable dollar, fight inflation aggressively even if it means slower growth or market corrections, and avoid turning the Fed into a perpetual stimulus machine. Yet something intriguing happened in the lead-up to his nomination. As Trump ramped up his second term and made clear he wanted a Fed chair who would deliver lower interest rates to support economic expansion, Warsh's public comments evolved. In recent op-eds and interviews, he argued that surging productivity, driven by artificial intelligence, technological innovation, and efficiency gains, could allow the economy to grow faster without reigniting inflation. He suggested the Fed had room to cut rates further, perhaps even aggressively, because AI was rewriting the old rules. He praised aspects of the Trump administration's agenda and aligned himself with calls for easier policy to help families afford homes, businesses invest, and the U.S. stay competitive globally. This pivot raised eyebrows. Was the hawk from 2008-2011 transforming into a dove to secure the nomination? Or was he pragmatically adapting his views to new economic realities like AI-driven growth? Trump himself addressed this directly in interviews, saying he wouldn't have picked Warsh if the nominee had pushed for rate hikes. Trump called Warsh central casting, polished, experienced, telegenic, and made it clear the pick was meant to deliver lower borrowing costs. Markets reacted with a blend of relief and caution. Stocks held steady or even edged higher in some sessions after the announcement, perhaps betting on eventual rate cuts. But bond yields ticked up slightly at times, reflecting uncertainty about whether Warsh would truly deliver dovish policy or revert to his inflation-fighting roots. The US dollar strengthened modestly against major currencies, as some traders saw Warsh as a credible steward who might preserve dollar strength long-term. Gold and silver dipped, on expectations of less need for inflation hedges if policy stays balanced. The bigger picture is a potential collision of visions. Trump wants a weaker dollar to make American exports cheaper, boost manufacturing, win trade battles, and inflate away parts of the massive national debt. A weak dollar turns U.S. goods into bargains abroad, revives factories in the Rust Belt, and juices corporate profits for exporters. But Warsh's career has emphasized protecting the dollar's value as the world's reserve currency. A strong dollar keeps import prices low, curbs inflation, and attracts global capital. If he prioritizes that, it could clash with White House goals, leading to tension between Pennsylvania Avenue and the Eccles Building. The Fed's independence is at stake here too. Trump has long criticized Powell for not cutting rates fast enough and has pushed for more influence over monetary policy. Warsh's nomination tests whether the Fed can remain insulated from political pressure while navigating a complex economy. Inflation still hovering above 2%, strong growth fueled by AI and fiscal stimulus, potential tariff impacts raising prices, and labor markets showing mixed signals. Confirmation hearings in the Senate will be intense. Republicans largely praise Warsh's experience and reformist bent, while some Democrats question whether he'll maintain independence or act as a Trump ally. The process could drag, but most analysts expect eventual confirmation given GOP control and Warsh's credentials. For everyday investors, this shift means the old playbook, buy every dip because the Fed will always rescue markets with liquidity, may no longer apply reliably. Volatility could spike as traders guess Warsh's true direction. Higher for longer rates would pressure growth stocks, real estate, and leveraged companies. Lower rates could extend the bull market but risk renewed inflation. Don't let fear drive you to sell. Markets overreact to uncertainty constantly. Look at history. The S&P 500 has delivered positive annual returns in about 75% of years since the 1980s, despite crises, recessions, Fed changes, and political drama. Pullbacks of 10 to 20% are routine. Bigger drops like 2008 or 2020 recovered in 1 to 3 years for those who stayed invested. Charlie Munger's rule still holds. If you can't stomach a 50% drop without panic selling, you're not cut out for above-average wealth. Treat market dips like sales at your favorite store. When quality companies, Apple, Microsoft, industrials tied to U.S. manufacturing, trade at discounts due to macro fears, that's opportunity. Focus on fundamentals, strong cash flows, competitive moats, reasonable valuations. Diversify across sectors. Consider assets that thrive in higher rate environments like financials or energy. Keep cash on hand to deploy when fear peaks. Warsh himself isn't infallible. In 2007, he downplayed risks in the banking system just before the crisis exploded. Experts get it wrong. Presidents do too. The only reliable edge is time horizon. If your money is for 10 to 20 plus years, retirement, kids' education, legacy, short-term chaos becomes noise on a long upward chart. This nomination reminds us the economic landscape can change fast. Easy money fueled massive gains, but sustainability matters. Warsh could bring discipline, reform, and perhaps a productivity-led boom that allows growth without bubbles. Or tensions could create choppy waters. Either way, discipline wins. Stay invested in quality, avoid leverage traps, ignore daily headlines, and let compounding do the work. The American economy has endured worse and emerged stronger. With patience and smart positioning, you can navigate this transition not as a victim of uncertainty, but as someone ready to capitalize on it. The game isn't over, it's evolving. Position yourself wisely, and the next chapter could be one of your best.